Welcome, everyone. Today, we are diving into the fascinating evolution of modern corporate treasury. We will explore how Treasury has transformed from a back-office processing hub into a strategic powerhouse driving enterprise value. Let's get started. Let's begin by defining what corporate treasury actually is. Simply put, it is the financial nerve center of an organization. Its primary duty is ensuring the company has the right amount of cash, in the right currency, at the right time, to meet its obligations. We cover the basics here, managing cash, funding, and mitigating risks like currency fluctuations. Why is this so crucial? Because a business can be highly profitable on an accounting statement, but if cash is tied up in inventory and it can't pay its suppliers tomorrow, it faces insolvency. How does it work? Think of Treasury as the plumbing of the organization, ensuring money flows efficiently to where it's needed. Taking a deep dive, modern Treasury is no longer just about pushing payments. It's about protecting the balance sheet, optimizing working capital, and managing complex global banking relationships to safeguard the firm's assets. Looking at this flowchart, you can see corporate treasury at the top, branching out into its three primary pillars. On the left, we have cash and liquidity, which directly feeds into optimizing working capital. In the middle, risk management tackles market volatilities like foreign exchange and interest rates. On the right, funding and capital ensure the business has the debt or equity it needs to grow. Each node represents a vital organ in the financial body of the firm. What exactly has changed over the last 2 decades? Treasury has evolved from a decentralized, mechanical payment processor into a highly strategic advisor to the CFO. Why did this shift happen? Major events like the 2008 global financial crisis and recent pandemic volatility proved that relying solely on external bank funding is dangerous. Companies realized they needed to mobilize their internal cash first. How did they achieve this? By automating mundane back-office tasks, empowering treasurers to analyze real-time data, and support strategic moves like mergers and acquisitions. When should a company make this shift? As soon as cross-border complexity grows, a strategic treasury becomes mandatory. In our deep dive, we see that a value-enhancing treasury doesn't just look at past bank statements, it looks forward, providing predictive insights to steer the entire enterprise toward its strategic goals. This progression chart maps the treasury journey. We start on the left with the transactional phase, where the focus is manual execution. Through automation, it becomes process efficient. As we apply analytics, it evolves into a value-enhancing function that protects margins. Finally, through close CFO partnership, it reaches the pinnacle on the right, acting as a strategic advisor that shapes the future of the business. What is treasury centralization? It is the process of pulling fragmented, local treasury activities into a unified regional or global treasury center. The basics involve taking the autonomy of external borrowing and investing away from local subsidiaries and managing it centrally. Why do companies do this? Because it saves a massive amount of money. It cuts down on banking fees, provides a global view of cash, and standardizes controls. How is this practically executed? Through an in-house bank. The central treasury literally acts as a bank for its own subsidiaries. If a subsidiary in Europe needs cash, it borrows internally from the in-house bank rather than an external bank, saving the bid-ask spread. For our deep dive, it is critical to note that total centralization isn't always easy. Treasurers must navigate complex local tax laws, currency controls in emerging markets, and cultural resistance from local managers. Let's examine this in-house bank model. At the top, we have the global treasury. Subsidiary B has excess cash, so it deposits those funds internally into the global treasury. Subsidiary A needs cash, so the treasury lends subsidiary B's cash directly to subsidiary A. The treasury only goes to the external global bank at the bottom if there is a net deficit across the entire group, dramatically reducing external debt costs. What is liquidity management? It is the fine art of making sure the company has exactly enough cash to operate, while investing every idle dollar to generate returns. The basics of this rely heavily on cash pooling. Think of pooling as gathering all your scattered puddles of money into one deep well. How do we do this? One method is physical pooling. At the end of every business day, funds from all local subsidiary accounts are physically swept into a master zero balance account. Another method is notional pooling, where the bank virtually groups the accounts to calculate interest, but the money doesn't physically move, which helps with local tax rules. Let's deep dive into a related concept, netting. Instead of subsidiaries sending hundreds of invoices and payments across borders every month paying FX fees every single time, multilateral netting calculates exactly who owes what, resulting in just one net payment per subsidiary. This slashes transaction costs instantly. This diagram illustrates a physical zero balance account, or ZBA sweep. Account A ends the day with positive 100, while account B is overdrawn by 40. Both are swept into the master ZBA account. The positive 100 covers the negative 40 internally, leaving a net positive balance of 60. This 60 is then automatically pushed into an overnight investment to earn interest, while both sub-accounts start the next day at zero. What is financial risk management? It is the practice of shielding the company's hard-earned profit margins from wild, unpredictable market swings. The basics involve managing foreign exchange, interest rates, and commodity prices. Why do we manage risk? Not necessarily to make a profit, but to create certainty. If you sell goods in euros, but pay expenses in dollars, a sudden currency crash could wipe out your entire profit margin before the cash even arrives. How do experts manage this? We use the image methodology. Identify the exposure, measure the impact using tools like value at risk, account for the transactions, govern via strict policies, and evaluate performance. In our deep dive, we execute this using financial instruments. A forward contract locks in an exchange rate for a future date, creating absolute certainty. Alternatively, an option acts like insurance. You pay a premium to protect against a bad currency move, but keep the upside if the market moves in your favor. Here we see the continuous cycle of the image risk management framework. It starts on the left with identify, finding hidden risks in the supply chain. It moves to measure, quantifying the risk financially. Next is account, ensuring regulatory compliance. Then govern, applying corporate policy and executing hedges. Finally, evaluate, testing if the strategy actually protected the firm. The dotted line shows this is a continuous, never-ending loop. What powers all of this strategy? The Treasury technology ecosystem. We are talking about cloud-native treasury management systems, or TMS. The basics involve aggressively moving away from Excel spreadsheets. Why? Because manual data entry is slow, highly prone to errors, and a massive fraud risk. How does modern tech fix this? Through APIs and global networks like Swift. Today, systems communicate using global standards like ISO 20022. For a technical deep dive, look at our sample concept. You can use a REST API payload containing a debtor account, creditor account, and instructed amount. When an invoice is approved in the ERP, this JSON code payload is securely fired via API directly to the global bank. This is called straight-through processing, or STP. Zero human intervention is required, costs plummet, and the payment clears in milliseconds. This sequence diagram walks through straight-through processing. First, the corporate ERP sends approved invoice data to the cloud TMS. Second, the TMS automatically fires an API post request with the payment payload to the global bank. Third, the bank instantly returns a confirmation status. Fourth, the TMS updates the ERP to reconcile the ledger. Fast, secure, and entirely automated. Let's look at a highly important, real-time use case, artificial intelligence and cash forecasting. What is the problem? Cash forecasting is notoriously inaccurate when done manually by humans. Imagine a global manufacturer that always keeps an extra $50 million sitting idle in low-yield accounts because they don't trust their own forecasts. How does AI solve this? We deploy a machine learning model that digests millions of rows of historical ERP data, seasonality, and market feeds. The AI detects hidden behavioral patterns. For example, it learns that a specific massive client always pays 5 days late during the summer. The AI dynamically adjusts the cash forecast in real time. The deep dive result: the forecast accuracy jumps from 80% to 98%. Because the treasurer now trusts the data, they eliminate that $50 million safety buffer, using it to pay down expensive high-interest debt. This single AI application saves the company millions. In this AI data flow, historical ERP data from the left and live market feeds from the right stream continuously into the central AI or ML forecasting engine. The engine uses pattern recognition to output a highly accurate cash forecast. This actionable intelligence flows directly to the treasurer, who can confidently invest excess cash or pay down debt, creating immediate financial value. To summarize, corporate treasury has undergone a massive evolution. It has moved from a decentralized, reactive payment processor into a highly automated, strategic control tower that guides the entire enterprise. As we look to 2030, success depends on three things: people hybrid professionals fluent in both finance and tech, platforms modular, API-first ecosystems, and predictive intelligence using AI to look forward, rather than staring in the rearview mirror. To stay ahead in this dynamic field, you must master these digital tools and strategic concepts. I want to invite all learners to like this video, subscribe to our channel, and visit quicktechie.com for premium certification prep. At quicktechie.com, you'll find comprehensive Q&A banks, full ebooks, audiobooks, full-length training courses, and interview guides to accelerate your career. Thank you for joining me, and I'll see you in the next session. Our final diagram shows the convergence required for the future. People with hybrid skills, platforms leveraging cloud and APIs, and predictive technology using AI all funnel into the central hub, Treasury 2030. When these three align, they output the ultimate goal at the bottom: massive strategic enterprise value. Thank you for watching.